Well, after a solid run in risk assets where real rates have been falling sharply and we've been seeing US dollar longs liquidating, we're starting to see a few jitters emerge across markets. Now, is this pre-positioning ahead of what is a blockbuster week of event risk next week, or is this the start of a more bearish trend? Markets are slowing down for the festive period, but it's about to heat up in financial markets. We go explore all these factors and more in the trade-off. Well, hi there. My name is Chris West. I'm head of research at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics. And we're going to be dissecting and navigating all the various landmines that we're seeing in the financial markets. And there are a lot, because next week we have one of the biggest weeks of event risk that I've seen for a long time. And that's going to hold all the cards for 2023. So it's really worth being aware of those event risks. And we're going to spell it out for you. We're going to talk about the risks that you need to know to hopefully help you navigate through that situation as smoothly as we can possibly can. Anyway, I'm going to bring Blake into the program. Blake, I feel for you, mate. Obviously, getting knocked out of the World Cup would have been tough for the family Morrow. But I guess you're all backing the three lines now as we take on France in the week to come. So, yeah, how much are you supporting England and how much do you think it's going to come home?
I'm supporting England all the way. I just don't think your team's going to win. Sorry. No. But I'm with you guys. I'm with you. So there we go.
There we go indeed. But it's like a massive week ahead. I think we really need to just go straight into it, don't we? And just address it. Yeah, look what the trades we're looking at, and maybe take a cheeky glimpse into 2023, which is next year. So I think without further ado, let's go into Topical Thunder. Well, Blake, why don't I go straight into broad markets? Because last week we were talking about the idea. Well, I was talking about the idea that we could see some follow through buying in the Nasdaq. Yeah, that worked for a period of time. We've started seeing equities really rolling over now. What I think is interesting as we go into one of the big themes for me of 2023 is the idea that we're going to focus less on high inflation. I think inflation will come down. There's a load of forward-looking indicators to suggest that inflation, CPI, if we take that, is going to come down to sort of 3-4% by the end of next year. So we can focus less about inflation and more on low growth recessions and how to position for that situation. I think the market is already starting to price that into an extent. But I think in the session we did hear Bank of America. We heard Goldman Sachs, the CEOs there saying about tougher times ahead. We've seen Apple, pushing back on delivery times for their, for certain cars that they're producing, the self-driving cars. And generally, there are some data points which are looking a bit ropey, and then there's some others which are okay. And the market doesn't really know what to make of that. But what we have seen is the S&P 500 breaking down, Nasdaq's breaking down. Real rates have been all over the place. They've been moving a little bit higher. Terminal rates sort of sticking around 5% in Fed funds. But there is a sort of a propensity to de-risk in equity markets. How are you reading this right now?
Well, I think that's exactly what it is. It is a lot of position squaring as we go into probably the most important 2 weeks of the remainder. Well,
it is, man.
It's the most important 2 weeks of the remainder of the year. It's a really important 2 weeks, though.
Well, that's it. So people want to take some time off for holidays. If you choose to celebrate it, and I'm saying no, get in front of your screens because it's about to get pretty wild out there, I reckon. So
it is. Hey, liquidity is going to dry up. Volatility is going to be high. That's also a really good warning to you guys and gals out there. Make sure that you are trading appropriately. A little bit smaller positions with less liquidity, more volatility. Don't let your losing trades get away from you. It's going to be a little bit more difficult to make that back, I think. So I think you've got to play defense. There's no sense in giving back all your profits from 2022 over the course of the next couple of weeks because some volatility may hit the markets. But I don't know. I think people are de-risking, Chris, and I think it is really. It really lies on the Fed chair here over the course of the next week.
I think it's about the CPI person. We're going to touch on that in a second. I think what we're seeing is, I think you're right. Look, we've had a nice melt up. We've had a really nice rally from those October lows. We got into the 200-day moving average. We got into the downtrend in the S&P. Markets are just saying, we've had a good run. Next week, it could get pretty wild. Let's just take some off the top. Does this turn into something a bit more bearish? Does this just turn into something a bit more sustained on the downside? We can talk about the triggers for that point. But, I think for me, you've got to be in front of your screens. Stops are absolutely essential, but where do you place them, of course, in that situation? And I think, if you're thinking about going to sleep, if you're thinking about getting some sleep, think again, you've got to be awake. You've got to be trading these markets. So sleep is a bad thing. Just trade.
And stops are paramount. That's true.
Yeah, that's right.
Which is key. All right. I want to talk a little bit and shift gears a little bit about the dollar and really the markets in general. After last week and the jobs data we got last week, the jobs data was strong. Economic data here in the US has been, not so horrible, but and we saw some ISM data earlier this week. The services data was strong too. Very good. And the market's really, for the most part, the knee-jerk reaction has been to shrug off the data. And I'm kind of sitting here, Chris, asking myself and asking you guys, do you think that's really too smart right now for the markets to shrug off data? I know everybody's looking past next week and everybody says, well, Powell's going to raise rates by, half percent and then it maybe raise rates another quarter or another couple of quarters into 2023. But whatever the case, whatever it is, we're going to look past that and the data is going to get worse moving forward. And the Fed is going to be forced to be a little bit more dovish or maybe even cut rates or whatever the case may be. So we're going to just start buying stocks now. Or is this the case that we talked about last week of FOMO? But at any rate, the data is still very strong. And I think dollar bears need to take heed of that the data is strong. And don't forget that Powell had been made to look a fool the beginning of this year with inflation ramping up the way it is. I don't think he's going to go out 22 buckling over and saying that the job's done. What are your thoughts here about this data not really moving the markets like it should?
It's two-tiered in a way. I'd just say that the Atlanta Fed, who run the Nowcast model, have upgraded their GDP forecast for Q4 to 3.4% from 2% or so. Some of the components of the ISM service number they've used in that. They've also taken out various elements of the employment data and the services employment data to suggest that retail sales coming up will be pretty strong, and therefore they bumped up their estimates there. So I think the US is running at a reasonable clip in this quarter, but you say that there is going to be a tightening process that goes into 2023, and then it will sort of meander a little bit lower. We've still got a few rate hikes that need to be filtered into the economy, and the Fed know there's a lag behind that. But if you look at services data, it's strong. The employment data is still pretty good, very healthy actually, to be honest. But some of the more interest rate sensitive sectors, manufacturing, certainly housing, have been pretty ropey for a while. And manufacturing is now in contraction. The Chicago PMI numbers were awful. I know it's smaller read there as well, but we expect a lot of that tightening of financial conditions to manifest into a slightly weaker labour market as we go into Q1, Q2, and that will probably be the trigger then for the Fed to hold off on rate hikes, and that will cause an extended pause. The big question is which I'll show you a bit later on, is will we get rate cuts next year? The market is pricing in 50 odd basis points of rate cuts into the second half of next year. Will it happen? Will it not happen? What happens if it does happen? How do we position ourselves? It's one of the big macro questions for 2023 that we will address going forward. But there's clearly a two-tiered economy at the moment. Employment, as we know, is a lagging indicator. It's one of the last to buckle. And when it does, obviously, some of the other areas, have already moved up. So, this is the Fed's conundrum. Is having to balance those interest rates when not everything moves as one, and that's a hard topic for these guys to get. So an interesting one. Look, I want to touch on going into the week ahead for next week, because it is a blockbuster. You said it's one of the biggest that we've seen all year. I think you're absolutely on the money with that call. So what have we got? We've got the CPI number on the 13th for you guys in the US, and the world revolves around the US, of course, as we know that. And it's going to be 12:30. Midnight, just after midnight, on the 14th for us Australians here. But for me, that's the big one, right? The market is expecting a slowdown. If you look at implied volatility in various markets per day, the big move in the dollar and in the S&P per day is actually on the CPI print, more so than the Fed meeting. So the market is expecting bigger gyrations on the CPI number relative to any of the other event risks. But next day, we've got the Fed meeting. The next day, or later on in that session, we've got the ECB meeting, the Bank of England meeting, the Swiss National Bank meeting. You've got the Norges Bank meeting, I believe. And I think just before that, you've got the UK CPI print as well. So it's absolutely crazy. And, I mean, how on earth do you navigate around that? We could be looking at the market 5% lower if we take the equity market, or we could be higher. So, right. How do you do it? What do you do?
Well, I don't know how you do it, but you're exactly right. This is a monstrous week, Chris, and you got to keep your head on a swivel. Always watch your six, keep your stops tight. Don't let trades get away from you. But I'm going to say this, that, from where we're at right now, we're either going to be down 10% on the year, or we're going to be down 20% on the year when you talk about just the S&P, where we're at right now. I think that a 5% move higher or lower by year end is really quite possible.
Yep, I agree.
And so you got to be prepared for either one. And when it happens, whichever way the market decides it wants to go, following the Fed, following the Bank of England, following the ECB, you start to see that market drift. It's important, and it's imperative. I can't tell you how many years I've been watching this at the year end, especially once you start getting into the holiday week and in between Christmas and New Year's holiday. The markets drift, and they just continue to drift. And a lot of traders have this sense, because we all do, right? We like to fade moves, reversion back to the mean. Yeah. I've seen things just continue to, snowball in either direction at the year end. And I have a feeling, Chris, this might be one of those year ends, especially if the market goes higher, that everybody's going to be chasing it higher into year end. So,
well, I just want to touch on the CPI print. So I'll just give you a quick, for people out there. I mean, we've only had 6 different economists coming out so far in the Bloomberg survey. Go to headline, 7.7% was the last read. Obviously, it came out below expectations, and that run a consecutive run of upside surprises. The market's looking for that to now to be at 7.3%, so 40 basis point decline. It is going in the right direction. The Fed want to see a sustained move lower. 2 readings. Is that sustained? 7.3% is the expected. Core is the more important read. The market's expecting that to go from 6.3 to 6.1%. If we get a 5 handle on core inflation, I think we rip higher. It doesn't take a genius to think that that's going to be the case. The market desperate to see lower inflation. A 5 handle, say 5.9, 5.8%. Yeah, the market rips higher. You're going to see the dollar coming under pressure, real rates moving aggressively, and you're going to see curbs moving all over the show. So yeah, that's the big one. Obviously, if we were to see inflation at 6.3%, which is unchanged, markets probably wouldn't like that. Certainly if we saw it higher, that would change the script. That would cause massive mayhem in markets. That to me is the playbook for the week. If we get a 6.4% on the core, I think you see the dollar spike up, dollar yen goes for it, and you're going to see the NASDAQ rally, come under big pressure. So that's the playbook I'm looking. That's going to be the most important data point next week. The Fed raised 50, ECB and the Bank of England do too.
Well, I was going to say we should just start rolling the timer right now on inflation. As you are discussing inflation,
yes,
it's a big deal. I mean, I want you to actually slow down and talk about your expectations of CPI here in just a second. But don't forget, we have producer prices on Friday. We got University of Michigan consumer sentiment on Friday as well. And by the way, how do you Australians trade data on Friday? Because it's so late. It's like midnight. Saturday, Friday night going into Saturday morning. Do you even trade it?
I don't, but I'm not as committed to the cause as some other people are, to be honest.
I was going to say, and if you're doing it, don't do it pissed, right?
No, I would never do that. But I mean, look, there's things like payrolls which come out on a Friday night for us, and so for me, the big decision is whether or not you want to hold exposures over to that or reduce them. And so that's where things like implied volatility comes in. When you look at what the market's expecting by way of movement, that can really dictate whether or not you want to hold those positions. Because in so many cases, you've got to be in front of the screen. And if I'm not prepared to be in front of the screen on a Friday night at 12:30 in the morning, then I don't do it. That said, sometimes you will wake up if there's a monumental event that needs to be happening. So okay. I mean, this is the thing for a lot of traders. If you are a pro trader, then you need to change, and you're trading day trading, you need to choose your time frame and the session that you're going to be trading and stick to it. So that's where you're going to be. So it's
all right. Well, going back to CPI, I do think it's going to be a big deal in it, and I think all of these inflation prints are going to really factor into what the Fed thinks and how the Fed chair Powell positions himself on, okay, Wednesday, your Thursday, my Wednesday, how he
6 o'clock
positions.
Thursday. Yeah.
But it's going to be really important. I think all of these 3 inflation reads are going to be super important to how the market responds. And you know, it's amazing, Chris, that you're talking about, you know, 6% core, you know, or maybe, you know, on some of these headline numbers, that those numbers might actually influence the Fed to be more dovish. And isn't that crazy to think about it? Because what their target for CPI is 2%. And here we are in some crazy bizarro world right now talking about these higher prints. So could you do us a favor and all the listeners a favor? Can you slowly go over what you expect for CPI next week?
I'll start with the other one. Sorry, I'm just going to go about it. I don't think PPI is going to be a major driver when that comes. No, I don't. I do acknowledge that everything's about inflation at the moment. Any inputs, yeah, we're a bit more sensitive than we usually would be. We might react to the University of Michigan 5 to 10 year inflation outlook. The market is expecting that to be unchanged at 3%. Obviously, if we were to see a number say north of 3.2%, then that has been a trigger for the Fed to acknowledge in their statements before why they had a hawkish turn. So maybe that's something that they will look at. If we get an unchanged reading at 3%, I don't expect too much movement because, as I say, next week's CPI number is by far and away the biggest driver of volatility this year of any data release, even more than the Fed meeting. So this is the one that we need to take into 2023. The script in the market's eyes, the wide consensus trade is that inflation has peaked at 9.1% on headline, and then it's materializing down to just about 3% by the end of next year. Anything that changes that script from here on now, the market will not like that, and they will de-risk, and you'll buy dollars on the back of that. So what do we need to see? We need to see a continuation of that lower move in headline, and we need to see a continuation of that lower move last month in the core number. So for me, core is the most important. As I say there, the market is expecting that to drop from 6.3 to 6.1%. 6.1 is expected. So as I say, if we get anything below 6%, I think the market will rejoice. This script that we know has been validated. We're getting more confidence to put that trade on. We sell dollars, we buy bonds, we buy NASDAQ in that case. Obviously, a number above 6.3%, and that script that we talked about is questioned. The market doesn't like that uncertainty, and they de-risk on the back of that. So really, that's the function that I'm looking for there, Blake. Hope that answered your question. Great. Yeah,
that's awesome.
Anyway, let's go into the playbooks. Let's go into some of the charts that are on Blake and my mind at the moment. Okay. Right, I'm going to go and have a look at the US 500. This is one that it's been getting bandied around by a lot of clients at the moment. So let's have a look at the daily setup that you can see there. We have broken out of this wedge pattern. We've also come into that downtrend that's been in place all year. We sort of tried to break out of the 200-day moving average once again. We talked about them this longer term moving average time and time again on the show. But the rejection of the downtrend and now the break of the rising uptrend or the wedge pattern makes me quite interested. What we have seen though, Blake, is this series of lows that we're coming in sort of back end of November around sort of 39, 36. That has held on a closing basis. We tried to break out. The buyers have stepped back in. So whilst we've got a completed wedge pattern, we've seen sellers off the trend resistance. We are just holding that level at the moment, and that's quite interesting. So we're not, time for aggressive short positions at this stage, in my opinion. But there are definitely red flags that make me quite nervous about this. How are you feeling?
Well, I am worried about it. Obviously, looking at that the wedge break, it's 3,900 is the level I'm watching going into the remainder of the week. So, because remember, between now and the time that we do see you next, we're going to be dealing with the FOMC, and we're going to be dealing with all this inflation data. And I would assume that this de-risking that we talked about earlier is really going to be around that 3,900 level. Whether we hold above that or below that, it's going to be pretty critical going into this next week. So, I think if you've been short, you got to be tightening your stops. And if you just entered short, you got to be thinking that there's going to be some support pretty close to here. There are a few things that make me question whether or not the stock market is really going to sell off any further. But, you know, one of the things we talked about last week is the VIX, and the VIX has actually rallied quite sharply off of that support. So that is that also leads me to believe that there might be further downside in the S&P.
I reckon turn of the year, if we do get a rally into the end of the year, turn of the year, there's things reset. I reckon there's going to be some great shorting opportunities. The thing that I want to go long the most right now, Blake, is Blake's grey hair count, because I reckon that's going to go up by the end of next week pretty badly. So there we go. There we go.
That's a good one. All right, Chris. Well, let's take a look at my setup here is the sterling, and this is the 50% retracement. Now, I tell you, you know, you guys that look at Fibonacci's, you'll never hear me say the 50% Fibonacci, because it's not a Fibonacci. It's just a 50% retracement. However, the market tends to look at that pretty, you know, quite a bit. So you take the highs, you know, from back in 2021 all the way to that low that happened in Asian trade about these times in the day. And we saw that rally. And, you know, as we hit new all-time lows in the sterling, we've rallied back 50%. But I think this sets up a good risk reward for a potential short, because what you might see there on that last couple of wicks yesterday is a little false breakout above that high, above that 123 level. And I think if we get much below the 200-day moving average, you might see some selling pressure. So what do you think about this sterling right here?
It's a difficult one because, I mean, obviously you're still beholden to a lot of the risk-off, risk-on sentiment. If we are going to see the S&P and the NASDAQ really make a bit of a dive next week, then you are going to see the dollar rally. So, you know, I think it's one of the things that perhaps taking the dollar out of the equation. If you like sterling, then trade it on the crosses. You know, trade it against the CAD. You know, trade it against some, you know, some of the other, you know, trade it against the NOK. Those kind of currencies have been working pretty well. You know, so I think maybe take the dollar out of the equation. But at the moment, you know, it's making higher highs, it's making higher lows. We haven't made a lower high, lower low for a while. So, you know, for me, the trend is still up. It's not really, there's no major conviction for holding shorts at this stage. You know, I want to see some of the, you know, the 3-day exponential moving average cross below the 8 to tell me to get out the trade using a mechanical stop there. But yeah, for me, the setup on it, at least on the daily time frame where you're getting that oversight, is not structurally negative enough to suggest that the buyers aren't going to step in. That's what I like about this is when the trend goes, you know, the buyers tend to step away, and shorting, you know, FX positions on a swing basis tends to be more lucrative. So yeah, I don't like selling it at the moment. But you're a fan of taking aggressive shorts at the moment?
I am. I mean, I think the risk reward is there. So as long as I've got good risk reward, I'm usually willing to take most trades. Yeah,
no, that's the way it works, isn't it? So I want to have a look at. Go back to the school days. And what I've done is I've shown you this chart because we talked about this idea that the market is pricing in rate cuts in 2023. Now, this isn't a trading setup, but I think this is a really important macro chart. So we go back to sort of the Western school of trading view, so to speak. And what I've done is you can see the code there that I've used. And what I've done is I've looked at euro dollar futures. So it's not like the currency. This is the interest rate markets that you can express a view on where interest rates are going to be for a specific period. And I've looked at the differential, the calendar spread effectively between the December contract and the mid-year contract there, the June contract. And the difference between the two effectively is how many rate cuts are being priced into the market for that specific period. Now, this is dynamic. It changes, it goes up and down. And what it does is it allows us to understand the hedging that's going in for how people are seeing this for next year. Now, you got down to about 60 basis points of rate cuts, a week or two ago. That's now come back up a little bit, just to under 50 basis points. I don't think we're going to get that aggressive rate cuts for next year, but if we do, and the market has been really good at leading central banks and economists, you know, after the pandemic, they were pricing in rate hikes, very aggressive rate hikes. Central banks were denying it. The market was right. Now, the markets at the moment are telling us that they're going to get aggressive rate cuts next year. If that's on the money, that has huge implications for our asset allocation and some of the trading environments that we're going to have for next year. So this is a chart that I think everyone needs to have on their radar. That's the code on TradingView. You can plug it in and you can monitor rate cuts for next year as well. So any thoughts on that, Blake?
I love it because if the market is pricing in rate cuts, that's good for stocks and that's good for risk. So that's all you really need to know. And if that starts to dissipate, well, you know, it's going to be risk off. I think it's a wonderful chart.
I think it's interesting though, because I don't think we get there in a linear fashion. We don't go just, this rate cut's being priced in, sell the dollar, buy risk. What we do is we know there's going to probably be some pain along the way to get central banks into the same spot that the market's in. So the market's saying we're going to get rate cuts. It's probably a hedge against a recession. But, if we do see a deterioration in the data, then the market might sell off until a point when the central banks acknowledge this weakness and validate the position the market's got. So it could be a really interesting one. We could see this period of weakness. Central banks acknowledge what all the market's already seeing, and then it's risk on, and then it's bang, sell dollars aggressively, buy rates, still yield curve steepen, buy the NASDAQ. So this is a really good forward-looking indicator, in my opinion.
Love it. Love it. All right. Well, I'm going to turn your attention over to the DAX. And for the third time in 2022, the DAX is dead.
He's called it. He's called it. There it is.
The DAX is dead. Part 3. All right. DAX is dead. This is going to be my chart. This is my setup. I love the fact that we've backed up against the 618 retracement, Chris. I love the fact that we're rolling over right where we should be rolling over. I mean, it's at that 14,550 level, roughly. You can see that horizontal resistance across the top. I think, and you can see by the circles that I've drawn, I think, again, risk reward is there. If you're taking a short position and you're shorting risk, maybe going into sometime later this week, maybe, Thursday or maybe Wednesday or, maybe Friday morning or something like that. And you look to sell against that 618 retracement. Hey, as long as it doesn't break out, then you probably play it back down to the 200-day moving average. So I think the DAX is dead for the third time in 2022. What are your thoughts on the DAX? Is it dead?
The term dead actually sort of symbolizes the idea that you can't come back from it in some capacity.
Right, no,
but it had a nice bounce back. But I know what
DAX
you're saying.
is dead near term. How about that?
Yeah, I like that. Well, we've closed below the swing low that we got on the 29th of November. It needs work. This has got a bit of a distribution look to it. If you're following your Wyckoffs and all these bits and pieces, but it's got a bit of a distribution to it. The question now is will this have the propensity to start trending lower? So for me, the signal has been provided that, we've got the lower low, we've closed below that swing low. The question now is will it kick? So it's aggressive to take shorts now, but certainly the red flag has been provided to the market that this has the propensity to start trending. So I'm not buying the dead call right now, but I definitely think that there are signs that you could be on the money there.
All right. Well, I'm like I said, if we can get any bounce and risk over the next couple of days, I think selling into it gives you a great risk reward to be on the short side. And
I think it was, and you know what, the other way to play it is you look at the lows that we've been seeing, and obviously there's going to be people who are going to be watching this 2 days after we filmed. But you just take the low from the last candle, which came in at 14,242. Put a sell stop below that level, and when the market breaks that, you're using the momentum. So you obviously do get a lot of failed breakouts, and they can be very powerful in themselves. So we talk about time and time again. But if you leave a sell stop below the market, if the market kicks on and it does what we think it potentially does, then you're in the trade and you're riding it down as a sort of a momentum move there as well. So that's another one to look at. Anyway, let's go into play of the day and see what the trades are that we like most there. Yeah, we had a couple of viewers talking about this idea that we need to be probably a little bit more accountable, or maybe not being so direct as that, but actually sort of having a performance review for our plays of the day and some of the other calls we make. And I'm completely about transparency and accountability. If you're chucking it out there, it's probably a good idea to sort of live by that situation. So that's something we will definitely address and explore in the new year to help you out. And then you'll know that you need to be backing Blake every day of the week and fading Chris Weston. So that's another thing. And it's not a funny situation. If you're obviously advising, or not advising, but just giving strong opinion, I think it's important to have accountability around that as well. And I know, Blake, you're not shy about addressing that as well. Anyway, let's go. So that's something we'll look at in the new year. I promise you that. We want to have a look at my play of the day today. I want to do a long short strategy. It's important to me ahead of the Fed meeting to address some of the concerns that we have. But what I've got here is the HK50, the Hang Seng effectively, but you could choose the China H shares or the CM50. And I've put it as a ratio on TradingView, so just dividing that against the S&P 500, or you could use the Russell 2000 on the Nasdaq. Effectively, I think that what I'm trying to do here by showing a ratio, and this is unhedged, the Hong Kong leg is in Hong Kong dollars, and you can see the US 500 is obviously in US dollar terms. But you can see if you were to hedge it, it wouldn't make much of a difference. We are seeing China outperform the US, and I continue to think that's going to be the case. If we are going to see the US markets kick lower, I think that's going to be, you're going to see significant outperformance. It's already happening at the moment. For long short strategies, obviously what you do is you start with a notional amount. I've used $100,000 here, unleveraged, and then you can work out your position sizing, your lot sizing, which is absolutely critical. I won't go into that too much there, but that's the sort of the math that I'm using to get an equal leg and a same notional either there. But for me, I think this goes higher. Why do I think that? Because I think China and Hong Kong continue to outperform US equity markets, and therefore, putting a pairs trade long short strategy makes a lot of sense to me. So that's my play of the day.
I love it, Chris. It's something actually I've been talking with our community at Forex Analytics about this week as well. I think with the China reopening and the issues that the U.S. is going to face in the next year, I think that is a great setup. Hey, my play of the day is going to be the Euro Mexican peso, and it's actually something that I did discuss with our community today, or earlier today. I'm actually looking to buy dips in the Euro Mexican peso, and I want to buy dips all the way down between where we're currently at about 20. Well, we get to 2050, roughly about there, all the way down to 2031. I'm going to be actually putting myself into the trade and the Euro Mex, and for an eventual breakdown in risk, which is going to benefit the Euro Mexican peso higher. I skipped today because of the we get hit if you're trading short Mexican pesos on a day like today. You get hit with margin, a little bit more margin on Wednesdays from the rollover period. But on these dips over the next couple of days, I'm looking to take it long, hoping it gets down to 2030. But if it only gets down to 2050, I'll probably have a piece on. And remember, this is a false breakdown. If you look that blue line, that's the low from February 2020. Euro Mex couldn't break down, dollar Mex couldn't break down, and I think the euro looks pretty constructive longer term. I like the Euro Mexican peso higher for a trade, and that's going to be my play of the day, Chris.
I think it's interesting. Yeah, I think the idea of carry, which the Mexican peso has done so well in 2022 as being a carry currency, because equity markets have had a nice rebound, and generally speaking, interest rates there have been very, very positive for holding Mex, getting paid in that. But I think understanding carry positions in 2023, if we were to see higher recessions and long end rates come down, and we do talk about rate cuts, then carry positions could come under pressure. That Euro Mex trade could work really well next year. So I know we don't hold positions necessarily for months. Not many people do, but it is one that I think that could trend quite well next year. So one for the radar. Anyway, if you've stuck with us, we really appreciate it. We've got a couple of specials next week where we'll be looking at some of the outlooks and some of the key trading thematics, not where the dollar is going to trade necessarily, but some of the key thematics that you need to understand what potential market structure is going to change. So we'll be focused on that a little bit next week. But anyway, if you could leave a comment about how you're seeing the markets, how you're trading the markets, always appreciated. Hit the like button if you can. We both really appreciate that as well. And we'll see you back next week, maybe even a couple of times for the trade-off.